The accelerating talks between Ottawa and Mexico City point to one clear reality. Canada is preparing a Plan B. Triggered by Washington's 35% tariff wave, both countries are moving fast to design new trade routes, energy corridors, and financing tools that could shift the balance of North American trade. While the headlines show diplomatic handshakes, the substance lies deeper. Energy investments, port and pipeline capacity. Access to financing, supply chain resilience. Together, Mexico's ports and Canada's pipelines open up trade networks outside the US customs zone. This isn't just theory, it's a live map of new routes being drawn. Canada's powerful pension funds, the Maple 8, could anchor these projects as long-term investors. Their role: to stabilize markets when US policies create volatility. Short-term, soften the tariff shock. Medium-term, diversify trade. Long-term, arrive at the 2026 USMCA review with stronger Canada-Mexico leverage. In the high-stakes game of global commerce, energy is the ultimate trump card. The most critical question on the table for North America is how Canada and Mexico will choose to play theirs. Will they double down on their existing partnership with the United States, or will they seek to reshuffle the deck entirely? The answer will define the continent's economic landscape for decades, creating immense opportunities for some and significant challenges for others. Consider the boldest scenario: a new energy corridor. Vast reserves of Canadian oil and liquefied natural gas, instead of flowing exclusively south, are rerouted through Mexico's burgeoning infrastructure. Utilizing deep water ports on both the Pacific and Gulf coasts, this Mexico bypass would open direct shipping lanes to energy-hungry markets in Asia and Europe. For Canada, this move unlocks unprecedented flexibility and bargaining power, breaking its dependency on a single customer. For Mexico, it's a golden opportunity to become a premier energy logistics hub, collecting valuable transit fees. But for US importers, it's a wake-up call, forcing a fundamental reconsideration of supply chains they once took for granted. Alternatively, there is a more subtle path. Canada and Mexico could maintain their current US supply contracts, preserving the status quo on the surface. But behind the scenes, they would quietly invest in these alternative routes as a strategic hedge, an insurance policy against future trade disputes or shifts in US policy. This dual-track approach provides optionality without immediate disruption. Regardless of which strategy prevails, the underlying message to the global investment community is identical. The prime directive is to protect cash flow through diversification, reduce geopolitical risk by avoiding over-reliance on any single partner, and secure the patient capital needed to fund these multi-decade infrastructure transformations. The smart money isn't just looking at next quarter's earnings, it's underwriting the next generation of global energy security. At the heart of this strategy lies the USMCA Joint Review on July 1, 2026. This isn't just a bureaucratic check-in, it's a high-stakes checkpoint, often called the Sunset Review, built directly into the agreement. The timing is critical, falling just after a US presidential election, meaning the political climate in Washington will be a decisive factor. If extended smoothly, it would be a powerful green light for the global business community, renewing trust and stabilizing markets. This renewed confidence would unlock a new wave of long-term capital, multi-billion-dollar commitments for advanced manufacturing, integrated supply chains, and ambitious green energy projects that require a decade or more to pay off. For corporations, this stability is gold, allowing them to confidently map out investment strategies for the next 15 years. If not, the agreement could enter a 10-year sunset period, set to terminate in 2036. This wouldn't be a sudden collapse, but a slow, corrosive unraveling of economic integration. The mere prospect would cause investment to freeze as companies price in the risk of a post-USMCA world. It would unleash years of uncertainty, forcing businesses to consider moving supply chains out of North America to avoid future tariffs and regulatory chaos. That's why Mexico and Canada are aligning now. This infrastructure push is a calculated strategic play. Every pipeline upgrade, LNG terminal, or port modernization is a tangible demonstration of their value as reliable energy and logistics partners. The implicit message to Washington is clear. We are indispensable to your economy and energy security. They are proactively building leverage, ensuring that when the review comes, the cost of disrupting the partnership is seen as unacceptably high. Despite the harsh rhetoric, trade is ultimately driven by price, delivery, and certification. Rules of origin, port capacity, customs codes. These are the real battlegrounds, not sound bites. Mexico wants clarity, and Canada is tying investments to green energy modernization, ensuring that diversification looks future-ready. Think of it this way. The US is the main trade highway, but Canada and Mexico are quietly building a backup line. More LNG storage in Mexico, faster coastal rail links in Canada, modernized oil terminals and sea trade ports. This backup line reduces market shocks, lowers financing costs, and keeps investors calm. And the market always rewards predictability over political noise. So, where does this leave us? The evidence points in two compelling, yet contradictory directions, bringing us to the central question that will define North American trade for the next decade. Is this a deliberate bypass of the US, or simply a sophisticated backup system designed to ensure trade stability? Proponents of the bypass theory see a calculated strategy. They point to the multi-billion-dollar investments in non-US ports and strategic north-south rail corridors as proof that Canada and Mexico are insulating themselves from the unpredictability of American trade policy. The goal, they argue, is a continental system that can thrive even with US friction. Conversely, the backup system argument suggests this is just responsible governance. In this view, these projects are a necessary hedge against global supply chain disruptions and a modernization of an aging network. The goal isn't to sideline the US, but to build a more resilient, efficient system for all three partners, ensuring goods keep moving no matter what. The answer has immediate, real-world consequences, especially with the high-stakes 2026 USMCA review looming. This isn't a routine check-in. It's a full-blown negotiation where every clause could be reopened. If Canada and Mexico have built a viable alternative network, they enter those talks from a position of strength. If not, they risk facing demands that could fundamentally alter their economic futures. The story doesn't end with ports and railways. The energy sector is a critical and often overlooked piece of this puzzle. That's why in our next video, we're going deep into the web of oil pipelines and LNG projects. We'll investigate how these energy flows are creating new economic dependencies and rivalries, and what it all means for trade costs and the price you pay at the pump. The geopolitical chessboard is being reset in real time. To stay ahead of the curve, subscribe and enable notifications. Every new move between Washington, Ottawa, and Mexico City could reshape the trade map overnight, and you won't want to miss what happens next.